Welcome to the FX Big Picture podcast. This is a series of podcasts where we will discuss a wide variety of topics and provide a rather different perspective from our experiences serving UK customers at NatWest. Morning, welcome to the NatWest Markets FX Big Picture podcast. My name is Duncan Maccabe and I work on the UK Corporate Foreign Exchange Sales team. Today I'm joined by Nel Parker, our FX Markets Strategist, and Dominic Conway, also from the UK Corporate FX Sales team. How are you doing today, Nel?
Yeah, very good, thank you. And I just wanted to wish Dom a very warm welcome to joining us for the Big Picture podcast. Thanks, Dom, for coming in and taking the seat that has been so rudely vacated.
No worries. Look, thank you for having me. It's I feel like the guest of honor. It's should be a good debate, and looking forward to it. Cheers.
A few podcasts ago, we discussed supply chain disruption and the challenges around forecasting and many other aspects for corporates. Today, we're going to discuss the year ahead going into 2022 and whether the emergence of the new Omicron variant of coronavirus has superseded this in importance. So, Neil, has this superseded supply chain disruption and other challenges that we've discussed previously?
Yeah, I think it probably has. I mean, it has for a number of reasons. It could possibly be another reason for supply chain disruption in the first place. So we might actually see further problems with regard to getting products from the place of manufacture back into the place of distribution and sale. But more importantly as well, I think it will have a negative effect, and I think we've already seen it having a negative effect with regard to things like consumer confidence. Additionally, it could have a negative effect with regard to the way in which businesses are able to staff, because we might see more people that are going to be off of work because of this Omicron variant. So I think there's a number of factors that could be a significant negative here because of the Omicron variant. And then I'd add into that as far as central banks are concerned, the central banks are likely to have to factor this in to their decision-making process. So they might have had a set plan. They might have been set fair to tighten monetary policy or to speed up the process of removing the loosening that's already been put in situ. But now with this new variant that is purportedly more highly transmissible, we don't know about whether it's more deadly or anything else. I think that could be enough of a factor to delay those changes to monetary policy, and also potentially put a downside risk to economic activity as we finish out and round out 2021 and head into 2022. So lots really here now to potentially throw a spanner in the works, not only for monetary policy but for businesses that are planning for 2022.
Any reintroduction of restrictions and any increase will affect the supply side much more than the consumer immediately, and so as we go into Christmas, we'll see how that really plays out, and that only time will tell how much confidence that we take into 2022 and beyond, and how the new variant really does emerge.
Yeah, I mean, I think I'd break this down in two ways. Number one, remember the pingdemic that we had through spring and summer, where that had a really negative effect on the labour supply, and it was in part responsible for the shortages that then occurred in things like fuel. So you've got that side of things on the supply side, which could lead to a much more challenging environment to get goods into the shops and stores or to their point of destination, that infamous last mile challenge for businesses that we hear so much about. But you've got the second thing, and you've already highlighted it, which is how will this affect consumers' confidence? How will this affect particularly the important elements of the services businesses that were looking so much for a boost going into Christmas from increased trading, and this new variant now could make them more reluctant to go to venues. We've seen reports on the news already about businesses losing tens of thousands of pounds worth of bookings as Christmas parties are cancelled, as people's gatherings are being cancelled. This is a critical time for those supply side businesses. And I think the demand side of things could fall away actually quite a lot quicker than the supply side if people do decide to act more cautiously over this new variant. So it could lead to a total loss of momentum as we head into 2022. And then we've got to go through the whole process, and it'll take a month or two, the whole process of rebuilding that confidence, rebuilding that demand in 2022. But you've missed that really important part of the retailing period and the services period, where it revolves around the Christmas and New Year timings, and that will be lost. It won't be recoverable.
I mean, the hospitality sector, this is not great news at all. Normally Christmas party seasons is when they tend to make their money and counter for January traditionally being a sort of fallow month. So look, yeah, this isn't ideal, and I do think the government will have one eye on that, and will be conscious of reintroducing maybe restrictions or sort of that pandemic scenario sort of repeating itself. So I think the government is very cautious at the moment. Is my sort of take on it, and we'll have to wait and see, as you say.
Yeah, I'd argue as well that travel sector looked as if it was just picking up, and now it looks as if it's going to go into reverse. We've got a very important ski season across Europe and in some parts of North America. You could lose another ski season. This could be basically the third ski season that you've lost because of COVID. And that will be devastating for parts of Europe. So it isn't just a UK problem. But it will reflect in much weaker turnover for travel businesses who are already challenged because of increased costs. Again, fuel costs have risen for them, and other costs have risen for them. They've probably had challenges around credit. They've probably had challenges because of the return of customers' monies, where holidays have been cancelled and they have to offer refunds as well as rebooking. The travel sector is another area that is going to be potentially significantly adversely affected by another series of restrictions, and the restrictions are being introduced across Europe. So it doesn't matter what we do to an extent. If those restrictions are being introduced on the destinations of travel, then it's going to have a materially negative impact on the number of people that are likely to travel.
And against this backdrop, Nel, there's still substantial amount of challenges that go into the cost mix for the UK corporate. And you mentioned supply of labour and materials and fuel. And the wage pressures too. So with that in mind, can you see delays in the expectations for raising interest rates from the Bank of England?
I've always thought this is a more complex subject than it's being laid out by media outlets and others unfamiliar with what's going on, particularly at the SME end of the UK's UK economic spectrum. So for those, they've not only faced all of those challenges, they've also taken out additional borrowing in order to keep the lights on over the course of the pandemic, and certainly that first lockdown. That additional borrowing is going to take years to repay. So those significant increases in the cost base that these companies have would only be made even more challenging by an interest rate tightening, even if it's a small one. Because of the signal that it sends, and of course the then wave after wave that you're likely to see of pricing in of additional rate increases in the interest rate swap market. So you have to look at all of that thing. For larger corporates, the big multinationals and everything, they're probably going to be able to ride this out pretty well. For smaller businesses, where there's the majority of growth potential, shall we say. I think there is a significant cost challenge, and I wouldn't be adding to it personally with interest rate increases. Even a small interest rate increase, I think, would be counterproductive when they're facing all of those issues that you've outlined, as well as higher taxation as well.
What do you think about interest rates in the US then, Neil? Because Friday we had a very weak payrolls number, and obviously the Fed has a meeting same week as the Bank of England. I think rate hikes probably off the table there now as well.
Yeah, well, they were never going to raise rates, but they were looking at potentially speeding up the process of ending their asset purchase program. I think the bar has been raised with regard to what other data is going to have to show in order to justify that speeding up the pace of that asset purchase taper. To put it into context, they would have ended the asset purchases by the end of June of next year at the current pace. So they're reducing it by around $15 billion per month. So they'd have got that done by June. And there was people talking about them finishing it by the end of March, so 3 months earlier than that, in order to give them some cover for rate increases coming in the sort of third or fourth quarter. If they decide not to go with that faster pace of asset purchase tapering, then I think you're still talking about the earliest for a rate rise being in the fourth quarter of 2022. And I would want, if I were sat on the Federal Reserve, I would want to see a lot clearer cut evidence that the economic growth that we're seeing out of the US is sustainable, and not just a function of the massive stimulus checks that have been paid to consumers over the course of the first half of 2021. Because if you look at their consumer confidence numbers are actually worse now than they were at the time of the initial pandemic. So there is not the clear and conclusive evidence from the US to justify an earlier start to rate tightening out of the US at this juncture, regardless of inflation being at 3-decade highs, because they keep telling us that the inflation is all transitory and it's going to be temporary and it's going to be washed through by the end of 2022. So why would you then start to jam interest rates up if you believe that the inflation is going to be gone?
I agree, but then the flip side of that is I don't think this is a short-term inflation problem that will be resolved by the end of 2022. You've only got to look at the client base and the survey that we did recently with businesses around the UK, and they say this is a problem going well into 2023 and not going anywhere anytime soon. I think some form of action needs to be taken.
All I would say is, given that we've spent the last 15 years prior to this rise in inflation with inflation rates at or below target levels, then I think we can be a little bit more relaxed about inflation being above target for a while. And the last thing that you want to do when, for the UK, you've only just about recouped all of your lost output due to the pandemic. In the US, you're a little bit above. In Europe, you're slightly below. Why would you want to start tightening policy? And why would the markets be pricing for interest rates to be higher in the UK than they were at the time just before the pandemic? That's my counter argument to you. At a time also when fiscal policy and taxes are going to rise to multi-decade highs as well as a percentage of GDP. So you've got a significant fiscal tightening coming over the course of the next few years in terms of taxation, and you're going to compound that with a sizable rise in interest rates as well. I think there's a danger that the authorities are being too complacent over the economic recovery and the sustainability of that economic recovery.
Doesn't sound like an easy mix for anyone working in the financial department of a UK corporate. Forecasting of the internal business, whether you're an importer or an exporter, how much you're going to need on the demand side, and also how much do you need to bring in? How much will you be able to sell? It's that part is and then how much is it going to cost? What the factors in the mix that are going to really influence?
It goes beyond
what can
that,
you
though,
sell at
Duncan.
and what can you produce to that?
It goes beyond that, though, Duncan, because, for the other factor you've got to think about is energy crisis, keeping the lights on in this business. Everything goes up in price because of inflation. For the UK corporate, this is not an easy situation. That can be summed up by the supply chain. This is well beyond that.
No, of course, there are so many competing pressures, and how foreign exchange can play a very, very large part, but it can also play a small percentage in all of that mix that we've discussed. And moving on to the foreign exchange element for the importers and exporters, Nel, what are your thoughts around planning? I'm sure there's certain sectors where there's greater certainty, but for others, I presume that this is, even as we were getting more normal, it is still a great deal of uncertainty in 2022. Is it going to be another year of consolidation rather than back in and all hands on growth?
I mean, I think there are a lot of businesses that have probably planned and prepared for 2022, but a version of 2022 that might not emerge. And so the phrases I would introduce is that there needs to be greater flexibility with regard to hedging. So you need to be able to be flexible on the timing of receiving the payments that you're going to get in because of that supply chain side of things. And you have to expect that markets are not going to be as stable or as calm as they were through 2021. I mean, it was extraordinarily unusual what we've seen over the course of 2021. You've seen sterling euro in a 5-6 cent range in total. You've seen sterling dollar in a 10-cent range. Normally they're double those ranges that we would see between highs and lows. So bear that in mind when we're looking at what the FX environment looks like. And also, 2021 we saw sterling dollar in the 142s. 2022, I would be highly skeptical that we will see it anywhere close to that. And I think there's a greater risk that if we do get more restrictions and potentially a nationwide lockdown, there's a real risk that the UK economy could be materially worse off than other economies facing the same levels of restrictions because of the weighting towards services and consumer spending that the UK economy has versus other economies in Europe and the Western developed world. So if you're looking at this from an FX perspective, you need to have that ability to be flexible, to not rely upon sort of what your budget rates are. Or if you do have budget rates, but you're hoping for markets to outperform where the budget rate is, well, make sure above all else that you don't end up getting worse than your budget rate. I think a lot of clients will have looked at 2021 as a missed opportunity. If you're a dollar buyer and if you're a euro buyer, you may well have seen the highs in both of those, and you won't necessarily revisit those highs over the course of 2022. There are, in my opinion, more downside risks than there are upside risks to sterling. There are more potential roadblocks and headwinds to the UK economy than there are to other economies. And I mean, me, like in terms of I'm no great lover of the euro and the amalgam of countries that make up the euro. But I do think that there's potentially more momentum behind the European recovery in 2022 than there will be for the UK's. And bizarrely, the European Central Bank look as if they've got their call right with regard to monetary policy and not jumping the gun. And it looks like the Bank of England are falling into the trap of looking at the current inflation numbers rather than looking at the potentially negative effects that we could see that have on economic activity. And it's got to be a balancing act. But for businesses, they will see greater disruptive forces in at least the first few months of 2022 as all of this stuff tries to sort of shake itself out. And then for the remainder of 2022, we may be in, again, another arms race to try and secure supplies by businesses because of everything having to step down in terms of production to then step back up again. And as we saw through 2021, demand spins up far faster than supply chains can. And that leads to your shortages, that leads to your problems, that leads to your price hikes. And I would go back to the point that Dom made previously, that yeah, this probably is a longer lasting inflation problem, but it's a longer lasting inflation problem because it's more likely to be a longer lasting supply chain issue. And consequently, businesses who are managing their foreign exchange need to be prepared for that.
So I'd like to come back to the bet you made there about sterling dollar sort of being in a 10-cent range this year and sterling euro 6 or 7 cent versus previous years. I think you've got to remember sterling is still higher than where we closed last year. So what are you saying? Are you saying that you think potentially we go back towards 125 in sterling dollar and sterling euro back towards 112? Because a lot of the treasurers I speak to still maybe clutching to straws, but still feel that actually the move could be back to the 140s. And for a long chunk of this year, people were thinking actually a move to 150 was on the cards for sterling dollar.
I hope that I'm wrong, but I think that there is way too much complacency about the potential for that move higher in sterling dollar and in sterling euro based around interest rate hikes. Because if you look at what the interest rate market's already pricing in, they're already pricing in those hikes. So if those happen, that shouldn't be a catalyst for a stronger pound, because it's only completing what the markets are anticipating. And we talk about in markets a lot about buy the rumor, sell the fact. I think the markets have already bought the rumor on this one. They already expect rates to rise. So when they do rise, it's no surprise. And consequently, sterling has greater potential to fall back post those moves. And arguably as well, with regard to 150 in sterling dollar, I don't think you would have ever heard any of the strategy team at NatWest utter the words 150 is on the cards for sterling dollar. We recognize the challenges that sterling faced, even in the low 140s. And we were very clear that those low 140s were, broadly speaking, as good as it was going to get.
I think about what's really interesting about our discussion today is that we've almost summarized 3 or 4 of our previous podcast topics, with supply chain disruption, known unknowns, unknown unknowns, and the psychology around managing your foreign currency risk and the necessity to remain flexible in the face of uncertainty and requirement for business planning and certainty. So I think it's incredibly interesting, and I think that unfortunately, where we were sort of feeling a bit confident and perhaps on the side of complacent, particularly in the UK, where restrictions had eased to such a degree that we're almost sitting back in a 2019 world, when we have a very stark reminder that we're not quite out of the woods just yet, and 2022 is going to be as interesting a case study as it is going to be challenging for businesses managing a whole host of financial challenges and having to risk manage that.
That's exactly right, Duncan. You know, we're in unprecedented times, but unprecedented times have become the norm now. And that's the challenge for all the corporate treasurers out there. And how do you manage that?
I couldn't agree more. I think, you know, when we're out speaking to clients now, one of the questions that we need to pose to them is your treasury policy fit for purpose? And that's a legitimate question, given that treasury policies were set before we even had any thought of the sort of supply chain disruptions that we've seen over the space of the last sort of 7 or 8 months. So I do think that we need to have some difficult conversations with clients, but out of those difficult conversations, hopefully, will come some solutions that they'll then be able to wind into their treasury policies, such that they're not going to get caught out by this sort of thing again. And that's what foreign exchange markets are. They're a permanent reminder that things will not necessarily stay the same. And when things do become more challenging and more difficult, then we have to be able, as a business, to adapt to it and to then provide a description of that adaptation to our clients, to say, well, this is what we think the markets now look like, and this is what the concern will be.
Thank you very much, Neil. Thank you, Dominic. I think this brings us very neatly to a close for this edition of the FX Big Picture podcast. And thank you all for joining, and look forward to speaking to you again soon in 2022.